Welcome everyone. My name's Jerry Miller. The bulk of what we do here at Trend Signal is looking at the charts. The charts, it's referred to as technical analysis. In the duration that we trade, the technicals, i.e. the analysis of price action, is absolutely key. What I talk about are fundamentals, which is to give you a little bit of color on what's driving these markets and help you understand what can affect the markets that you're trading. To help you decide whether to take some trades when there's some key events happening, such as elections, interest rate decisions, etc. Anyway, we start the week just looking at the calendar. You'll note that we've had clocks change, not just here in the UK, but also across Europe. So our clocks have gone back 1 hour, which means that the US markets close an hour earlier. In that the gap between us and the US is now 4 hours. It only lasts a week. The US puts their clocks back next weekend on the 3rd of November. So all end of day routines are 1 hour earlier, effectively. Yeah. So what is going on? Well, the answer is the NASDAQ. The NASDAQ has finally, the tech stock index has finally edged above its all-time highs. If I just show you the NASDAQ chart here, something that, you know, this market topped out in, I think, mid-July, and since then it's struggled to get back its mojo. But actually, on Friday, it actually hit its all-time high, although it failed to hold on to it. You can see the pullback that we saw in that candle. You can see that big wick. Obviously, market's up nicely today so far, but that is the last week. The NASDAQ was sort of unchanged, but actually unchanged to slightly higher. That was its seventh advance, weekly advance. So it's been quite an interesting move. And in contrast, the S&P 500 actually lost ground last week. It fell about 1%, but it's still above its or at its all-time highs, whereas the NASDAQ has been struggling to maintain or regain its all-time highs. So quite different charts. The difference between these indices, the S&P 500 is the 500 top stocks in the United States, weighted by market capitalization. The NASDAQ are particularly tech-focused stocks, but there are a lot of tech stocks, obviously, in the S&P 500 because they're large stocks. It's interesting, though, that last week was the S&P's first weekly fall in 7 weeks, whereas the NASDAQ has actually rallied every week for the last 7 weeks. There we go. Anyway, going back to what's happened over the weekend, overnight, I was showing you the UK oil market, a big plunge in oil. You might think, gosh, what's happened? The fact is that the Israeli Defense Force carried out that much talked about retaliation against Iran for its missile barrage against Israel. What was it, 3 weeks ago or so? And escalation concerns aside, because it's still not sure how this will play out, oil markets have plunged because the IDF targeted only military sites and not oil or atomic infrastructure, which is really what the US had hoped for. But global markets have responded positively to the response coming out of Tehran. It's quite a measured response, really, which suggests that the war won't escalate anytime soon. And there was quite a bit of anticipation built into the oil price that this retaliation could hit oil infrastructure, which would send oil price spiraling higher. Anyway, that's not come to pass. The market has gapped down. We're actually about $1.50 lower from the opening from last night, but that's already gapped down. I mean, the previous close on Friday night was around $75.50, currently trading at $71.20. So this is a big fall, big fall. Anyway, back to stocks. So what is happening with regards to the tech stock? Since the middle of July, when the NASDAQ hit its peak, there's been quite a lot of I call it rotation out of tech stocks and into the broader market, which has really persisted, as I say, for these past several weeks following the NASDAQ topping out. And I think the significant rallies that you've seen in these, what been referred to as the mega cap stocks or the Magnificent Seven, has generated concern amongst a lot of investors that the market was supported by just this handful of stocks. And most other stocks were sort of flat to only up marginally. And I think the reality of lower interest rates has also hit the mega caps as investors assess the loss of interest that these mega cap stocks were going to incur. But basically, at the likes of Amazon, Apple, they've got huge cash piles that make a lot of money out of their cash reserves. And that's something that also added to the slightly negative slant on the markets over the past few weeks. Anyway, these mega stocks or Magnificent Seven stocks, they've recovered with investors focusing again on AI, the effect on earnings that AI will bring. And you've got the likes of Nvidia. I was looking at it the other day. It hit 3.4 trillion. And then again, last Monday, it's hit another high at 3.5 trillion. And I think it's pretty close to that at the moment. So not just Nvidia, which is the chip stock company that makes the AI chips that are in much demand, but you've also had Apple and Meta have also made record highs, which really underlines the strength, the renewed strength in the tech stock. And I'm asked, well, what about this election next Tuesday, the presidential election? I don't think it's having any effect or very little effect on investor sentiment. The key swing states that are very balanced, and the recent polls that all of us have access to give each candidate less than a 2% lead over their rival, and that's within the bounds of error. So no one really knows what the outcome is or will be, and the markets just carry on as normal because we don't have any way of forecasting it, and the effects will only be felt when the policies are played out over the months after the election result. UK markets continue to be dominated by the upcoming budget. For those of you in the UK, that's all there is in the press. Talked about possible tax rises, possible spending plans, etc., etc., and it's gone on for so long. The budget's come at a full 16 weeks after Labour's victory at the polls, and which is the longest gap between the new administration and its first budget in decades. And the effect, I think, has been to worry almost all taxpayers, despite Labour's view that they will not raise taxes for working people. And I think even at the weekend, the classification of what a working person seemed to confuse one of Labour's ministers, who said that SME owners and landlords were not working people. So it's just confusing a lot of people, but it worries people. It worries taxpayers. And it's been manifested in the sharp drop in consumer confidence as consumers hold off spending. And why wouldn't you? If you're uncertain about how the budget's going to affect you, that has a big effect. Equities, UK equities, well, we only need to look at the chart to realize, a bit like, and Stuart was referring to some of those sideways charts on the New Zealand dollar pairs. Look how sideways the market has been since for the last 8 weeks. This is a daily chart, but it's just chopping, wicks at the top, wicks at the bottom, and every time it tries to make a break, it comes back down again. And it's not surprising because there are rumors about the oil sector being taxed, banking sector, gambling sector, could affect the house building sector, real estate sector. So as a fund manager, they can't make any decision. They have to wait until the budget. It's too risky to take any major position. So everything hinges on this statement by Rachel Reeves this Wednesday. And bond yields have also been affected, actually. It's quite interesting, everyone sort of harks back to when Kwasi Kwarteng announced his budget and yields went spiked through the roof. It's happened a little bit, but on a much smaller scale over the last month. The yield on the 5-year gilt, if you look at the screen, currently at 4.09%. A month ago, the 5-year yield was at 3.86%. So, yields have ticked up by about 25 basis points. And remember, yields rise as prices fall. So gilt prices have been falling, yields have been going up. And that's because investors are worried a little bit about Reeves' confirmation that she'll change the fiscal rules. She talked about including government assets when calculating government debt, and obviously her spending plans. And it's just a reminder to the government that it's not an open-ended sort of checkbook. It has consequences if investors lose confidence in her plans, and that's something that she should have taken note of anyway. Currencies, Japanese yen is all the talk overnight. This is the Japanese yen chart. You can see it's weakened further. So just to be very clear, this is the number of yen to the dollar. So as the number of yen to the dollar increases, that's the yen weakening, the dollar increasing in value against the Japanese yen. And it's really down to the disastrous outcome of the snap election called by the new Prime Minister, a chap called Shigeru Ishiba. The LDP had governed with a coalition, and when Ishiba became the new leader of the LDP, he called a snap election, and it's gone disastrously wrong. The LDP governing coalition failed to get 50% of the seats in the DIT, and the task now, I guess, is for the LDP to form a coalition. But I noticed that the Ishiba said that he will look to form a new government, and he's been quite firm in what he's wanting to do. But it's a tough one to negotiate. He's got to negotiate with parties that he's not been best friends with, and I think that'll undermine both the yen and investor sentiment. Until that's resolved. Other than that, the dollar continues to push ahead, as you can see here in the dollar index chart. This is ever since the whole discussion about big cuts in interest rates by the Federal Reserve seems to have been reversed. It all started back in early August when we had a very poor non-farm employment change, when for some reason in the height of the summer, investors thought that the US was going to go into a mild recession. Can you believe it? Anyway, that's all reversed, and that's seen very clearly in the way that the dollar has rallied. And also, the market is also pricing in a little bit of the risk that Trump gets in, and Trump's isolationist and tariff policies will actually cause the dollar to strengthen, something that Trump actually doesn't want, curiously. But there we go. That's the strength in the US dollar. Oil markets we've talked about. Gold market we know is a barometer for sort of global angst, and so that remains reasonably firm, close to all-time highs, up $24 last week. Just show you a quick chart. So we are a smidgen away from the all-time highs, and the trend is your friend, and the trend in all time frames is up on gold. So data out this week. Let's just review the calendar. I've already mentioned that we've got the daylight savings, so we're an hour difference. So we're down to 4-hour difference with the US for the next week. We've got non-farm employment change at the Bank of Japan and the budget to discuss. So let's just get straight in. Nothing coming out on Monday. Tuesday, we've got these monetary policy hearings. This is where the Bank of England got a chap called Andrew Bailey and a few of his monetary policy committee members testify on inflation and the economic outlook. That's got to be interesting for the markets, hasn't it? And that's something that the sterling will be particularly sensitive to. Curiously, it's a day ahead of the budget, so I can't think there'll be much in the way of reaction to that ahead of the budget, of course. CB consumer confidence in the US, that's Conference Board consumer confidence, always a very interesting read. These are good leading indicators. They're telling us about future activity. Here, investor confidence, consumer confidence, I should say, is improving, and quite rightly so. Certainly responding to the stock market performance and also the improving job market. Why wouldn't they be more confident? We then jump to Wednesday, and the first thing I'll mention is the autumn. It's called the autumn forecast statement. It's the budget. It's the autumn budget. Tories have sort of flip between having a spring statement and an autumn statement, but this is very much the autumn budget for the Labour Party, 16 weeks after they came to power. And I think it's that void of policy that's created so much uncertainty in it. I think lesson learned: do not wait 16 weeks after coming to power before setting out your budgetary plans, your spending and taxation plans. Anyway, obviously we know a lot of what has been talked about: national insurance, inheritance tax, CGT, all this sort of stuff, and we'll find out. 12:30 on Wednesday afternoon. Sterling UK assets very, very sensitive to this announcement. Well, the release of what the plans are going to be, I should say. ADP non-farm employment changes. This is the private payroll company ahead of the Bureau of Labour Statistics announcement on Friday, which is the real non-farm employment data coming out of the States. Less impactful, this particular one. It's the one on Friday that we all focus on. We then have the first reading for gross domestic product in the United States in the third quarter. So that's July, August, September. And you might think, gosh, we're only the end of October. Have they collated all that data? Well, they got 3 data releases. This is the first one. It's called the advanced one. They've only collected 40% of the data. It is a good indicator, but look at that, 3%. Wow, 3%. Contrast that with Europe's growth rates. It's extraordinary. We're not even close, at all close, in fact. Thursday, overnight, we've got the manufacturing and services PMI data. All I can say is balanced. Yeah, 50 is neither expanding nor contracting. That's not what Beijing wants, especially after the stimulus plan that they put into practice, announced, sorry, about 3 weeks ago or so. They've got they got their work cut out in China with falling prices, which is depressing economic activity. Businesses can't invest, they can't put up prices, etc. It's something they have to arrest that decline, and I think possibly more stimulus measures might be announced in the next few weeks as well. Bank of Japan monetary policy meeting. Wow. Well, after the snap election and the surprise result of the LDP coalition failing to get a 50% majority, it seems odd or unlikely that the Bank of Japan will make any change in policy decision. Up until Ishiba, the new prime minister, who actually said he favored no increase in rates, he said that about a month ago. The Bank of Japan was probably looking to increase rates gradually, but that's just a little bit in the balance now. But I think on balance, in the medium term, they will likely increase rates marginally, literally sort of 10 or 15 basis points at a time. Anyway, it's up to the Bank of Japan to decide all that, and not the new prime minister, despite his views on it. We then have core CPI flash estimates. This is the inflation reading in the Eurozone, 2.6%. Yeah, remaining subdued. Euro and Eurozone assets will be sensitive to that announcement. We then have the inflation reading in the States. I say the inflation reading, it's actually called the personal consumption expenditure, and it's the core reading we're looking at. And the Fed uses this as their best measure of inflation, not their CPI reading, expected at plus 0.3%. The core rate had moved higher in August as headline data fell. So it's weird how it sort of fluctuates between the headline and the core, but inflation really looks to be, it is remaining subdued, and it's unlikely to affect the Fed's interest rate decision, which is next week. To look forward to next week as well. Friday, it's a holiday called All Saints Day. I think the likes of France, Italy, Spain markets are closed. And Belgium, I'm told, as well. Belgium markets, if you trade them. And then the main event of the week for Fed watchers. Employment data is important because it influences what the Fed do. They are charged with maintaining full employment, as whatever the definition of full employment is. That you have to have some people unemployed for an efficient labour market. But we're expecting just 111,000 new jobs That's 111,000 new jobs. Last month we got 254, which was almost double what the market was expecting. I think it's almost like a correction on the print last month. Could it be a misprint? I doubt it, but it's just the way that the data's collected. Average hourly earnings up 0.3% and unemployment rate at 4.1%. Yeah, the jobs market is looking okay. It's certainly improving since August. And I think the market won't want to see new jobs much less than 111,000 in October. Much less than that, the consensus, I should say. But if there is a below consensus print, the dollar and US assets will be particularly sensitive to it. So that's definitely one to watch. At 12:30, remember, everything's an hour earlier this week because of the shift for a week in the time difference. And then finally, we've got the US manufacturing PMI data, which manufacturing continues to struggle. It's the one that got hit hardest by the spike in energy costs and the spike in inflation. And it's really struggled ever since that. And if you look at this chart here, you can see how manufacturing has failed to get above 50 ever since really the last quarter in 2022. So it's been a big struggle and it continues to struggle. That's it. Thank you very much for listening. I hope all is well, and we'll catch you again next week. Bye for now.